Tenet HealthCare Corporation, stock ticker THC, on the Russell 2000. Value ratios in millions of dollars, millions of USD. Current stock price $136.01. June 17, 2024. By Dwayne Gray. Earnings per share. Profit divided by weighted average number of common shares outstanding. 1.1311 divided by 101,640 equals 1290. The ratio is an important element judging an appropriate market price for buying and selling common stocks. A rising trend in earnings per share has favorable implications for the price of the stock. In practice, a common stock market price reflects the anticipated trend in EPS for the next 12 to 24 months, rather than the current EPS. This is common practice to estimate EPS for the next year or two. Accurate estimates for long periods of diff, of diff, accurate estimates for long periods are difficult because of the many variables involved. Fully diluted earnings per share. Adjusted profit. Adjusted weighted average number of common shares outstanding. 2,510 divided by 1,004,800 in thousands equals 23.95. Because of the importance of earnings per share, analysts pay close attention to the possible dilution of the stock value. Dilution occurs when the number of shares outstanding increase, which results in existing shareholders owning a small percentage of the company. If it may cause changes such as conversion or outstanding convertible securities, exercise of warrant, and shares issued under employee stock option. Fully diluted earnings per share can be calculated on a common stock outstanding plus common stock equivalents such as convertibles, preferred, convertible debentures, stock options, under employee stock option plans and warrants. This figure shows the dilution of earnings per share that would occur if all equivalent securities were converted into common shares. PE ratio, price to earnings ratios, continue. Because the many variables involved in forecasting earnings, you should use the estimates and calculations with great caution. The PE ratio helps analysts determine a reasonable value for a common stock at any time in the market cycle. By calculating the company's PE ratio over a number of years, you'll find a considerable fluctuation in high and low points. The high and lows of a particular stock PE remains constant over several stock market cycles. They indicate stock selling and buying points for the stock. So you have PE ratios of competitor companies, and that of the relevant market subgroup index also provide a perspective. The PE ratio comparison assists in the selection process. For example, if two companies with equal stature in the same industry have both similar prospects but different PE ratios, the company with a lower PE ratio is usually a better buy. As a rule, PE ratios increase in this rising stock market or with rising earnings. Earnings that increase over time are a favorable sign. The stock price should also rise over time. Just seeing rising earnings are a positive development and are willing to pay a higher price for the stock. The increase in the stock price is usually greater than the increase in earnings. Therefore, PE ratio increases. PE ratio, price to earnings ratios, continue. The reverse is true in a declining market or when earnings decline. Example, at the start of a bull market, the PE ratio of DEF Corp was 10 to 1 based on the stock trading at $10 per share and an earnings per share of $1. The bull market continued with DEF reported higher earnings at 2.50 in the next quarterly earnings report. Mr. Comment drove D price of DEF Corp higher to $43 per share, resulting in a PE ratio of 17.2 to 1. Generally, it is assumed that when investors' confidence is high, PE ratios are also high. When confidence is low, PE ratios are low. Because the P/E ratio is an indicator of investor confidence, the high and lows may vary from market cycle and market cycle to market cycle. Much depends on changes in investment enthusiasm and for the company and industry over several years. The P/E ratio of individual stocks are also affected by many factors specific in individual companies, such as comparative growth rates, earnings quality, and risk due to average stock liquidity.